All right, let's set the scene. Imagine you're in that corner office. You're the engagement partner at a top firm, and landing the titanium robotics account is the biggest deal of the entire year. Your reputation, your career, heck, your professional license is on the line. So, there it is, the draft audit engagement letter, just sitting on your desk. You can feel the pressure from your partners, right? This single client could lock in the firm's revenue for the next 3 years. It's huge. But as you're scanning the terms, your eyes just lock onto a single clause. One sentence that could bring this whole thing crashing down.
And there it is, right there in black and white. The auditor shall not require access to the chemical disposal logs. Wait, what? They're telling you, the auditor, which parts of their business are off limits. Let that sink in for a second. This isn't some polite request. It's a hard line in the sand before you've even set foot in their building.
Okay, so this is not a minor detail we can just negotiate away. In the world of auditing, this is what we call a poison pill. It's a classic textbook example of a limitation on scope. And the fact that they're trying to slip it in right at the start, that is a massive, massive problem.
Think about it. The CFO is on the other end of the line just waiting for you to sign. Your partners are expecting you to close the deal, but you know deep down that signing this letter is career suicide. It's a total deal breaker. So what's your play here? What do? In a moment like this, all the noise just fades away. You forget the client, you forget the revenue, and your brain just snaps right to the rulebook. Your first and only loyalty is to professional standards. And in this case, that means one thing: Standard on Auditing 210 or SA 210. This is the standard that gives you the exact playbook for this kind of high-stakes game.
You see, SA 210 is basically your shield. It's a gatekeeper. It's not about how you do the audit. It's about deciding if you can even start the audit in the first place. And to make that call, you have to check if a couple of fundamental preconditions have been met.
So SA 210 really boils down to two critical tests. First is the financial reporting framework they're using, like IFRS or US GAAP. Is it acceptable? For our scenario, let's just say, yeah, it is. But the second test, that's where the real action is. You absolutely must get management to agree on the fundamental premise of what an audit even is.
So what is this premise? Well, it's really just a formal way of saying that management has to acknowledge their responsibilities. They need to be on the exact same page as you about what their job is and what your job is. And lucky for us, there's a super simple and really powerful way to remember what they need to agree to.
Just remember these three little letters, PIA. Seriously, burn it into your brain. Think of it as the PIA test. This little mnemonic is an absolute lifesaver for any auditor looking at a new client. It just cuts through all the noise and gets right down to what is not negotiable.
Let's break it down real quick. P stands for the preparation of the financial statements. That's their job, not yours. I is for implementing the internal controls needed to make sure those statements are actually accurate. Again, that's on them. And finally, A stands for access. They have to agree to give you access to everything, all information, all records, all people. And here's the key word: unrestricted.
And boom, right there, that's the heart of the problem. Titanium's demand for no access is in a head-on collision with SA 210's requirement for unrestricted access. It's not a gray area. It's not up for debate. It's a direct, undeniable contradiction. This isn't just a technical issue. It's way bigger than that. This is a massive red flag about management's integrity. Remember, other standards like SQC1 and SA 220 say you have to evaluate if you can even trust a client's management before you sign anything.
I mean, why would a company want to hide its chemical disposal logs? This should be setting off every alarm bell in your head. What are they hiding?
So now you have your answer. The standards don't just give you some friendly advice, they give you a crystal clear directive. This is that moment of truth. It's time to stand your ground, armed with the full authority of your profession. This is what we call the Auditor's Gambit.
The rule is just so clear. SA 210 basically says this. If a client tries to impose a limitation on your scope that's so significant it would force you to issue a disclaimer of opinion, which means you can't even form an opinion, then you shall not accept the engagement, period. And blocking access to an entire division's compliance reports, oh yeah, that is absolutely significant enough. You literally have no choice here.
So you pick up the phone, you call the CFO, and there's no arguing, no trying to find a middle ground. You just calmly and clearly state the facts. You say, look, under SA 210, unless I have completely unrestricted access, there is no audit. So you can either remove that clause or you can find another firm. The ball is now in their court.
Now, this whole story isn't just for drama. It's a perfect case study for concepts that are absolutely critical, whether you're staring down an exam or you're already out there in the field. So let's just nail down the key things you need to walk away with.
Okay, number 1, establishing the preconditions for an audit under SA 210 is not optional, it is mandatory. Number 2, always use that PIA mnemonic to make sure management is on board with their responsibilities. 3, and this is the big one, never ever accept a scope limitation before you start if it's going to lead to a disclaimer. And finally, number 4, remember that taking on a new client is also an evaluation of their integrity.
So you've made your move. You've put professional standards ahead of a massive contract. The line on the other end goes completely silent as the CFO takes it all in. The game has begun. So I'll leave you with this to think about. What happens next? What do you think that CFO is going to say?